It's inevitable. It's inevitable that the world will wake up and notice that Africa is the fastest growing demographic region of the country and economically growing region of the world. And, it may take another 5 or 10 years until the world wakes up. By then, we will still be around. There's no best buy date for us. There's no expiration date. There's no 10-year deadline. So we will chug along, we will grow as fast as we can grow, and we will either be a $50 million company or a $500 million company when the world wakes up. Either way, there are hundreds of billions of dollars that could flow into Africa to invest in this sector. Not every market is winner take all. Very few markets are winner take all. Most markets, you have competition. Coca-Cola has Pepsi, American Express has Visa, or vice versa. Like, having one provider is not necessarily a good thing. It can make some investors some money, but it's not necessarily good for the world.
Before we get started, I wanted to pause and thank you. The fact that you're watching or listening means the world to me. None of this would be possible without you. And every time you subscribe, every comment you leave, every episode you share, it allows me to keep having these conversations with people I never imagined I'd sit across from. So if you haven't already, please do hit the subscribe, tap the bell so you never miss an episode, and let me know your thoughts in the comments. This podcast is a journey we're building together, and I couldn't do it without you. In Silicon Valley, investors chase apps, the next big AI, or in the times of blockchain, anything that had to do with Web3. But in Africa, Luni Libes is betting on eggs, cassava, honey, goats, and it might sound simple, but it's scaling revenues, feeding communities, and rewriting what impact investing really looks like. He walked away from the US startup scene to build something that most investors wouldn't touch. It's really, he calls it the Berkshire Hathaway for Africa. What if the greatest business opportunity of our lifetime is hidden in solving hunger? Luni, I'm thrilled to have you here.
Well, thanks for having me. I do want to add, it was a great intro, and I do want to add, and we beat the returns of the normal VC funds and PE funds and S&P 500 along the way.
Let's start there. I think the biggest misconception about impact investing is that it's philanthropic, perhaps a lower return. What has been your experience, and why do you generate more return than the normal funds?
Yeah, it can be. There are certainly impact investments that are bordering on philanthropic or trading off impact for returns. But there are also many impact investments like Africa Eats that don't trade off, that provide both returns and impact. And the key to those are that the impact is embedded in the business model. So every company that we invest in is solving hunger and poverty by buying food from farmers, doing something with it, getting it to market, selling to retailers. And there's some other business models in our portfolio, but primarily that's it. They buy food that smallholder farmers are producing. They pay them cash, which gives them an income. Our research has shown it generally doubles their income. They have a median income for their country. So they are no longer subsistence farmers. They can pay for school fees. They can pay for healthcare. They can pay for shoes. Everybody eats in the family every day. And so that is literally removing poverty. And then the traditional supply chain in Africa loses a third to half of the food between the farm and the stores. And in our supply chain, we lose a single-digit percentage. So in terms of hunger, that's how we measure success against hunger. We're simply getting the food that's produced in Africa to the mouths of Africans to eat. And because we're getting more food to market, prices come down, less imports have to happen, less hunger happens. So I've seen others like this, but if you always invest in companies where they don't have to think about the impact, they just have to think about running a business and growing, then the impact happens and the profits happen too, and the value grows.
It's definitely a different mindset. And I think that Peter Thiel comes to mind when he said 0 to 1 is an infinite return, and then 1 to 2 is what you're saying is.
Sorry, I got a face palm on the Peter Thiel. Not every market is winner take all. Very few markets are winner take all. Most markets, you have competition. Coca-Cola has Pepsi, American Express has Visa, or vice versa. There's multiple airlines, there's multiple banks, there's multiple supermarkets. Like, having one provider is not necessarily a good thing. It can make some investors some money, but it's not necessarily good for the world. Like, it would be nice if we had some competing search engines, but We don't.
Right. My point was more towards the value creation from when you go from hunger to having a better supply chain. There's such a big increase in value that perhaps that's what's driving the bigger return.
Maybe. Mostly I would chalk up, there's a lot of different pieces to it. It's complicated, but if I had to boil it down to one thing, it's that there are these huge opportunities that are just there for entrepreneurs to grab. For example, let's go out of the hypothetical and just talk about chickens in Rwanda. Nice and simple, right? We probably everyone who's not a vegetarian listening to this is eating a chicken. And every vegetarian knows what a chicken is. And so country Rwanda, it's landlocked. It had a genocide in the 90s. It was the very poor country not too long ago. It's coming out of that now. It's one of the fastest growing economies in the world. And when the middle class grows, well, they want to eat meat. And that's not a bad thing. Sorry, vegetarians, but protein deficiency is a humongous issue, much more than diabetes. And so feeding kids some chicken once a week is a lovely thing to do. Problem is that chicken was so rare in Rwanda that it cost more than beef. And that was true until last year when my investee became the largest chicken processor in the country of Rwanda and produced enough that the price of chicken came down to be less than beef. And so now chicken is affordable to more Rwanda. Okay. Well, that opportunity has been around for 30 years, but nobody bothered to fund it. Nobody bothered to support any entrepreneur that wanted to fill that gap. So it went unfilled. And so again, kind of, I do like to make fun of the tech crowd now that I'm out of it. But like, we didn't have to build an app for that. We didn't have to like find something that someone might want. There's no product market fit here. It's chicken. We already knew chicken was a product market fit. We just needed to figure out how to scale it up. And it took, like, I invested first time in that company in 2017. So it took 8 years for it to get up to the scale where it was making a difference for the whole country. And it's in fact exporting to like 5 other countries as well now.
It's fascinating. And I want to go from perhaps your journey, because you could have stayed in Seattle in the startup world. What was the emotional turning point that pulled you into Africa?
The Africa part was happenstance. The part that pulled me into impact was I stumbled across a business school called Bainbridge Graduate Institute. That was March of 2011. So I was running my 5th tech startup. We were backed by, who funded that one? There was a California VC and Voyager Capital and then Seattle. And it was Disney money. It was Steamboat Ventures. Anyway. And at that point in my life, I had zero big exits. I had 4 of my 5 startups still running, still selling products that I helped build. And I figured I must know something. I don't know what it is, but that's not normal. It's not normal to be a serial entrepreneur with 5 tech startups. It's also really not normal to have them still up and running, selling product, right? Usually they crash and burn or they get acquired. And so I stumbled across this school. I asked them if I could help in any way. They said, sure, come sit in the back of the classroom, help our students, however you feel like. Well, I wasn't looking for it, but it turned out that this was the first business school in the world to teach how to do good through the tools of business school, like how to do the impact entrepreneur side of impact investing. At the companies that we invested. I mentored those students for 9 months. And then my tech startup, we merged it with another startup and it left town. And I had zero desire at that point to do another tech startup. At that point, I realized that I could, instead of following the Andrew Carnegie, Bill Gates model of go get rich and then give away your money, I could start a company that both did good in the world and made money. And I didn't quite know how to do that in 2011, beginning 2012, but I figured it out. I built a business accelerator like Techstars for, at the time we called them mission-driven for-profits because we didn't have the impact word. That term wasn't popular yet. And we stumbled across the fact that there were these huge opportunities in Africa. The accelerator invested in like 30 companies in Africa, 20-something in the food and ag space. And Africa Eats is a spinoff of that work. All of the companies came through a Fledge accelerator somewhere in the world. We're in programs in like 8 cities in the world, 4 continents. And so we found all these companies by hanging up a shingle saying we're an accelerator. And it was an accelerator like Techstars that invested in these companies. So I was, by business model, writing small checks and then realized, oh, there's a huge opportunity here. So when the pandemic hit, I spun off Africa Eats, and that's my day job. I focus on those companies and mostly those grads, and check in with the other ones that are not doing food and ag in Africa. But I spend 99% of my time focused on on the Africa Eats portfolio.
It's fascinating because I feel that most VCs, most funds, they stumble into something, and it sort of seems like you did too. And you said impact was such an emotional turning point, but then Africa drew you in. Was there something about perhaps African entrepreneurs that you thought was like different or intriguing that you were like, this is
Yeah. Okay. So
American entrepreneurs could learn from them?
the first one I invested in was a 24-year-old Tanzanian kid who had just graduated from undergraduate and just got his bachelor's in finance. There's no friends and family money. It's very, very little friends and family money in Africa. So how do you start a company? Like the normal American path is you get your friends and family together and get some seed capital, or you get a credit card or pilot credit cards, right? I think Airbnb was famous for that. Well, this kid, he hustled, took the bus, which was like 17 hours, I think, to Nairobi and back each way, 17 hours. And he, bought some computer stuff, brought it back to Dar es Salaam in Tanzania, sold it for a profit, went back, bought some more, sold it for a profit. And he made $4,000 of profit, right, on a handful of these trips. And that was his seed capital. And then I found him when the company was just about a year old, and it did $100,000 of revenue and broke even on $4,000 of investment.
Wow.
So I'm thinking there seems to be something here. And then, the next cycle of the accelerator, 6 months later, found some more entrepreneurs. No one has ever beaten that level of revenues per dollar investment. But still, the key piece that's different about African startups, if you let me use that term, is there are a lot of them where if you ask them what was last year's revenues and how much money has ever been invested in the company, there's a lot of young companies where the ratio is more revenues than investment. And in all my work in the States, working with startups, mission-driven in tech here, I've never once seen that in the States. It's always, we raised $500,000 of seed capital, and next year we're going to have 100,000, right? And we're raising a $5 million Series A, and with that we hope to get $1 million or $2 million of revenue. Whereas in Africa, in the kinds of companies I was looking for at the time, yeah, we got a $5,000 grant and we're doing $25,000 in business. We got a $10,000 grant and we did, $50,000 in business in year 3. And it could be younger. It could be we got that $5,000 grant from this one billionaire in Nigeria, Tony Lumulu, and with that we made $7,500, right, or 8,000, or so forth. And one of them, one that we picked in the 2020 cohort, yeah, they were like that. I think they got a $10,000 grant. They were doing, they had just finished the year at $24,000, up from $11,000 the year before. So two singles there. One is they've doubled their revenues in a year. 2, they did it on almost no money. And oh, by the way, we only invest in profitable companies. We don't do that VC thing where someday there might be profit. No. We invest in companies when they're profitable and they stay profitable, minus some weather hiccups or other hiccups. But in our portfolio, 23, I think we have 21 profitable companies left.
It's fascinating because I feel perhaps the rest of the world, this is more normal. It's only the Silicon Valley where more normalized model of lose money, it doesn't matter because you're going to be acquired. Is it because you feel there's no exit plan other than just being profitable?
Okay, so we fly all of our entrepreneurs to Nairobi once a year for a 2 to 3 day internal conference. Part of what we do that's special is they solve each other's problems, right? They're all building companies in the food and ag space. There's only so many things that can go wrong, right? There's a few hundred things that can go wrong. If you think about the birthday paradox, right? So if you get 26 people in a room, odds are 2 people have the same birthday. Maybe 27, the exact number. Well, we have 25 founders. We get them in a room together. Odds are whatever challenge all of them have, each of them have a challenge in front of them, or 2 or 3, probably someone solved the challenge already. So we get them in the room and they solve each other's problems. At this point, I'm forgetting why I'm answering in this way. I remember what the question was.
The problem of not having an exit plan, okay, that they just have to be.
Yeah. So twice now, the last time we did it was for show. We asked them, show of hands, who's interested in selling your company? Like right now, who's interested in selling your company? No hands go up. Who's interested in selling your company in the next 5 years? One hand goes up.
Really?
If we say, fine, there was actually a reason why we did this a few years back. But let's assume we had a billionaire funder and he was willing to buy your company once it had 5 million in annual revenue. We will hand you a $10 million check in cash when you hit 5 million in annual revenue. Who wants that deal? One hand went up in the room. So it's not just that there's no exits. There are a lot of entrepreneurs, including most of mine, who have no desire to have an exit. They are building a company. They started with a tiny little company. It was, them and their co-founder, if they had one, it was, hustling to sell a few tens of thousands of stuff. They remember that day. And now a lot of them are over $1 million in annual revenues. They don't want to give up now. They want to build $100 million company. They want to be the
Yeah.
biggest brand of their kind in the region. And you can't do that by selling out to somebody, even if there was acquirers, which there aren't. But they have no desire to do that.
What about investor appetite for businesses that might not be sold? How can you, the first question when you raise money is, when are you going to give it back to me?
Yeah.
If this only comes from cash flow, how do people perceive that, and how do you navigate those type of questions?
Yeah, we definitely got that question for 4.5 years. We call the book is Berkshire Africa. We reference Berkshire Hathaway a lot. I'm an acolyte of Warren and Charlie. And so we took a lot of lessons from Berkshire Hathaway. And one of them was, well, you can be a publicly listed company. Like you can be an investment company that's publicly listed. And nobody asks Warren, how do I get out? It's obvious. There's been a path for that since he bought his shares. You sell them to somebody else on the stock exchange. So we went through a big effort. It took us 14 months, but on December 3rd last year, Africa Eats became a publicly listed company. And by the time we did that, we were at $2.25. We started at $1. So we were 2.25x return in 4.5 years. And some of our investors said, that's lovely. I'll take that. I'll go do something else. I don't know where they're going to find that in impact to repeat that, but a handful of our investors said, I'm done, I'm good, and sold their shares. And a whole bunch of other investors said, oh my God, I want that, and bought shares. So investors can leave whenever they want.
Interesting. Let's deepen this Berkshire Hathaway, similitude or perhaps model. Yeah. What are the principles that you think are completely translatable to do it in Africa, and which ones were you like, perhaps this one, it doesn't really translate that well?
Okay, so two main things we can't do yet, but we will in the future. One, the first acquisition Warren made from Berkshire Hathaway outbound was an insurance company. Well, there aren't any insurance companies we can buy. So the whole insurance side of Berkshire, we can't do yet, but we do plan on doing in the future. We plan on, we have to spin them up from scratch. And the second piece of Berkshire that we don't do at all and don't want to do is wholly owned subsidiaries. So again, show of hands, who wants to sell your company? Well, no hands went up, which is good for us because we don't really want a whole bunch of, we're not building a conglomerate. We don't want a bunch of wholly owned subsidiaries that we own completely. We much prefer working with entrepreneurs and empowering entrepreneurs. So we kind of use the other half of the Berkshire business plan, which is they don't truly care if they're buying all or part of a company. We like to only buy parts of companies. But that said, actually, there was a conversation I had recently. So that's our general principle. Sorry. And then the third piece that we do copy is we invest forever. Like Warren's quote, which he actually got from Charlie, is the best holding period is forever. If you bothered to do the work to go invest in a company and you like it, keep it. Don't sell it. So that's our general ethos. Okay. I'm sure we will have exceptions to that. I'm sure some of our companies will get acquired along the way. It's inevitable from their fast growth. And then the other thing that came along that will break these assumptions is I was talking to an entrepreneur. I won't say where or what they do because I don't want to give that away, but African. It's not one that's in the portfolio. It's one we got introduced to. I'm learning about his company, and I'm fully expecting at the end of this conversation for him to ask me for money because that's what everybody does. And at the end of the conversation, instead, he said, I have two questions for you. What's my company worth and who would buy it? And I'm like, okay, well, here's how much your company's worth. Boom, top, give them a range. And yeah, we might buy it. So there is that opportunity in front of us where we could buy an existing company that wants out and then merge it into an investee and then hand the merged company off to the investee to run. So we'll wind up with a minority stake in the bigger entity. And and then we handed that opportunity off to the founder of the acquirer and said, you tell us if you want to do it or not. If you do, we'll make it happen. If you don't, then the guy has to find an acquirer somewhere else.
Do you feel that, going back to the investor question that everybody says, I want my money back, how hard do you feel it is to convince people, aside from your track record, which is there, beside that you took $1 share, took it to 2.25, beside being able to show how hard is it to raise money for this type of initiative?
Yeah, just because it's $2.60 now, so it's over 2. It's still really hard. It is still incredibly hard to get investors to want to invest. The biggest hurdle is it's Africa eats. And most Americans, the only news they ever see of Africa is bad news. There's almost never a good news story in the newspapers in the US. And I don't live in Europe. I gather it's similar in Europe. So for 99.99% of all high net worth individuals, family offices, small institutions, small fund managers, they see the word Africa and they just run away screaming. They go, no, that's too risky. That's all corrupt and there's wars and whatnot. And then they missed all these opportunities. That's why we can fund these companies. Nobody's funding these companies.
What do you think they don't understand, or what could you say, or what do you say when someone says Africa? Oh, no, it's so corrupt. What do you feel has moved the needle for them to be like, actually, I should think twice. There is a blue ocean here. No one's funding, so I have no competition. It's great if you can invest into the next Facebook, but really nobody's going to come to you for the next Facebook. There's too much competition in the States, but in Africa, you might be the first one.
Yeah, I tell them, we've improved the lives of at least 1 million Africans already. We have grown the value of the shares on an average of 26% per year every year, or 6x in 5 years. I don't see any reason why we can't do it in the next 5 years. And the next 5 years, the opportunity sizes seem to be 1,000x for these companies. Most of them have 54 more countries to expand to. 1 billion more people to reach, 1.2 billion more people to reach. That's what we pitch. And some of them will eventually say yes, and a lot of them just can't get past that word Africa.
Was there a moment of doubt, or a voice perhaps saying to you, it's too risky, it's too ambitious, that perhaps you had to silence?
No. I'm a serial entrepreneur. Those thoughts come on bad days, but most days it's like, it's inevitable. It's inevitable that the world will wake up and notice that Africa is the fastest growing demographic region of the country and economically growing region of the world. Sorry, both of those world. And, it may take another 5 or 10 years until the world wakes up. And by then we will still be around. The lovely part about not being a fund, there's no best buy date for us. There's no expiration date. There's no 10-year deadline. So we will chug along, we will grow as fast as we can grow, and we will either be a $50 million company or a $500 million company when the world wakes up. Either way, there are, hundreds of billions of dollars that could flow into Africa to invest in this sector. We'll be ready for them.
I love the conviction. I can see why for you it's so clear. Was there
I got to add to that. Sorry, before you jump to the next question. Again, I did spend 20 years in tech. I did take money from California VCs over and over again. We don't have a runway. Okay. So all of our companies have been profitable. The way I like to say it is none of them need money, right? In any given year, again, there's a hiccup or two. We can fill in that gap, but nobody's burning capital. We just missed the break-even mark by a little bit. So nobody has a runway. Nobody has to have money in order to have their business exist in another year. Mm-hmm. They have an infinite runway. Which means the only reason we're raising more money is because the opportunity is there to grow, and the opportunity is there to, improve the lives of the next 1 million Africans. So that's nice to have, but not needed. If the investors take their time to come, again, we'll still be around. The optimism's there because there's really no deadline for us. We're here, we're growing as fast as we can. More capital will let us grow faster, less capital will let us grow slower.
And I understand, and I relate to having a lot of entrepreneurs looking for profitability and how resourceful they might be. What is your process to understand who meets the cut and who doesn't?
So the criteria when they were selected was team, impact, odds of success. That's how it gets boiled down. So you got to have a great team. Don't have a great team, it's not worth investing in them. Do they have an impact that can scale to at least national size, if not regional? We don't invest in village scale companies. We don't invest in a company that can only ever operate in one city. And then odds of success have all the things from business school in it, including opportunity size, competition, capital efficiency, which country are they in, things like that. So that's what we look at and continue to look at when it comes to finding new companies. And we are inches away from adding the next one in.
And when a traditional VC, there's many ranges of how hands-on they are, how they help entrepreneurs. What has been your mindset to this? Is it a very Berkshire approach where you get great people, you let them do it? Or do you have, because they came from accelerators, you still hold their hand a little bit until they grow? Or what's your process?
Okay, so yes, it's Berkshire-esque, but very hands-on at the same time, which sounds oxymoronic. So we find these companies when they're tens of thousands or a few $100,000 in revenue. When you're running a company of that scale, most entrepreneurs do it in their gut, right? They don't have very many processes yet. And then between 4 and 6 years later, for a lot of these companies, they're now doing $1 million of revenue. Well, you can't run $1 million a year company in your gut. $1 million equivalent, by the way, it's local currencies. You can't do that in your gut. You have to have a finance manager. You have to have good accounting. You have to have an ops person. The founder can't be doing everything him or herself. It has to be a team effort. So we know this. The entrepreneurs don't quite know it when we find them because they haven't done it before. They're all first-time entrepreneurs. And so our hand-holding is always with the founders and the management teams to push them to more formalize their processes so they can handle being a bigger company. No need to invest in them if they have no desire to get there. And then when you get past $1 million, those processes just need to get hardened even further. And then some complexity shows up in terms of being bankable or being able to finance trucks or with leases and stuff. Things that you can't do as a smaller company. You have more options. And then once you get past $1 million in annual revenue, other funders will start looking at you. And so we need to handhold our entrepreneurs on how to do that. And then what we also did last year was we publicly listed 2 of our companies. So we didn't do it to exit. We did it to raise money. So the founders didn't sell shares. We didn't sell shares. We used it to raise capital in the equity market. And so that was a lot of hand-holding. And that was not only a lot of we had to learn how to do it. We listed Africa Eats in 2 companies all in the same day, all in the same process. So we were learning it and we were teaching it all at the same time. So yeah, there's a lot of hand-holding. But when it comes to operation, it's not our companies. We're minority owners. We do not do sales. We don't do marketing. We're not hiring and firing employees. That's them. The management teams take care of that. So that's very Berkshire style.
And I really like the growing together. Like you just mentioned this example of listing publicly 2 companies at the same time, including your own. It's combined growth. It's not really a paternalistic view. It's more like, hey, we're here to figure this out together and let's keep the momentum. And because we learned it once, now all your other companies are eligible to get there once they're ready or if it makes sense for them.
Yeah. And again, it doesn't have to come from us when the next one is prepping to go public. We have 2 founders to point them to. Like it's very bottom up. It's very collaborative. We do get guests to come to the first day in our annual gathering, as we call it. And I usually start off, I'll do a little speech to explain what Africa Eats is. Africa Eats is not me and my team. Africa Eats is all the companies and me and my team. Like we are Africa Eats, even though it's not a conglomerate. We don't own majority of any of those companies. We are the largest investor in most of them, but not 100% of them. Africa Eats is still the whole thing. But we are something together. We are building this thing together and have been for 5 years now.
What was your most irrational investment decision and what did it teach you?
Oh God, that's a good question. Off the top of my head, should we go? Let's go for a near failure. Yeah. In this process, I said it's team impact, odds of success. One would think it's also finishing the application. Like there's a formal application to apply. But what I found out is the service I was using to collect applications at the accelerator would let me read them when they were starting to get filled out, partially filled out. The entrepreneurs didn't know this, but it was a feature of the system. So I made a habit of looking at the uncompleted applications at the end of the process. I'd screen, 400, 500, 600 of the completed ones, and then just to see what was there. And a lot of them were truly incomplete. A few of them, they just never pressed the submit button. There's always be a few of those. And then there was one that caught my eye that was only half filled out. He just abandoned it halfway through. It was 2015. He was a cab driver in Seattle, and he had accidentally created the largest cook stove company in Africa. And there's a long story behind that. We don't have time for how he did that. And so I reached out to him and I said, well, as long as you're in Seattle, why don't you stop by and I'll just chat with you. And so he stopped by, and he's just a human being I couldn't say no to. He's just a lovely human being. And so, yeah, he got invited in. And then I did have a big exit in my tech from one of my tech companies. And I put 10% aside for do-gooding work. So I put 5% in a donor advised fund to give to charity, and I put 5% of that winnings into his company personally. Okay, that's the good news and the heartfelt story. It's in Ethiopia. And so that company has currently survived 2 civil wars and a pandemic. It was not turned out to be a good investment in terms of monetary value, and it's been passed up as the largest cook stove company. But it did a lot of good. And he's an amazing human being, and we haven't given up on him, and he hasn't given up. But, in terms of should we have invested in Ethiopia? Yeah, not the most rational place to invest. Not back then.
Even though with this lesson and story, are you more aware of where you're going to invest? Are you still like, well, if this guy was able to pull it off in the harshest conditions, let's just market is secondary? Or perhaps country is secondary?
No, country's definitely not secondary because this is not one of the $1 million a year companies. Countries do matter. Stability does matter. So as much as I don't want to scare people away from Africa, there are places in Africa you shouldn't go and you shouldn't invest. Like there are countries that don't have governments. Ethiopia's coming out of that funk. I hear it's booming at the moment. I think fourth fastest growing economy on the planet. It's like doing a China level of growth now. So it's probably a great time to go back. I just introduced that entrepreneur to an investor who is focused solely on Ethiopia. So hopefully they'll help turn that one around. But in terms of risk taking, we write really small checks. So we are willing to take risks that no one else will take. There are still countries I haven't visited where I have investees. I don't know other institutions. They always talk about boots on the ground. They want to go and see the site before they invest. Okay, that's nice. But if I'm investing in a company with $24,000 in revenue, there's not much to see anyway. It's what's that company going to look like in 5 years, not what it looks like today. So I'll have them, shoot their own little site video on their phone. But there's places I haven't been yet, even though I invested in the company 6, 7, 8 years ago.
If, and I think Africa Eats will succeed beyond your lifetime, what would you like it to be like the legacy, or what would you like the DNA to be embedded with from your philosophy, from your thinking?
Okay, so I personally went to the Berkshire Hathaway shareholder meeting in 2024 to see it and experience it in person. It is a bucket list thing to do. You have to be a shareholder, but you only have to have one share of Class B, a few $100s. 40,000 people showed up for that event. That company at the time was 59 years in Warren Buffett's control. It's from the 1800s. It's an old company, but it was Warren's company for 59 years at that point. All these people came out to hear, how it was doing and hear his wisdom and so forth. And then I was in Nairobi for this year, so I watched it live streamed. And he announced, unexpectedly, he announced he was retiring. Nobody expected that. And so, my dream is that Africa Eats, when I'm 92, 93, is not quite that big. Okay. That won't be 60 years in, but is on that same trajectory that we're, that's like not quite 40 years from now, like 35 years from now, we are a humongous institution across Africa with, I don't know, 100, 200, maybe even more companies in the portfolio, billions in total revenue that they're generating. And maybe if it's 1,000 companies where, 500 of them are still teeny and we're working on them, and 500 of them are, the other half are big and established. And so to be the equivalent of Berkshire Hathaway. And if people don't follow it, what I find amazing about Berkshire Hathaway is it's the 7th most valuable company in the United States. The only ones that are more valuable in it are the big tech companies, right? From NVIDIA, Apple, Microsoft, Google, so forth. Every oil company is smaller than Berkshire Hathaway. Every bank is smaller than Berkshire Hathaway. Every brand that you can think of that isn't one of those 6 tech companies is smaller than Berkshire Hathaway. The only other public company in the world that's bigger is Saudi Aramco. Every other brand you know of, every airline, every every fashion brand, everybody's smaller than Berkshire Hathaway. There's something about the way that Warren built that company that we think is replicable, but no one's bothered no one's really tried. So we're giving it a go, and we're doing it on a different continent.
It's a very exciting and huge vision. It definitely draws people to see like why isn't there a parallel in Africa or in other continents. The model that you're shaping definitely seems to be the right one.
Yeah, thanks. Yeah, as far as I know, no one's ever tried. But that's the answer, right? And that's a very common thing that again goes back to my days of raising capital with VCs in California, and they're like, well, where's your competition? You can't say there isn't any. Like, even if there isn't any, like, okay, well, we're just the first. Like, hopefully we're not the only, but we're the first doing this model of money and guidance and perpetuity and building things together. No one's really tried that before, outside of Omaha in the 60s and 70s and 80s.
I know this is a huge bet that you're making, and it's a very conscious one, but is there a bet that you are making that is maybe more secret? Perhaps your big bet is Africa and Berkshire, but is there something you're working on right now that you're very excited that you haven't announced yet that you think is going to be a very big change or game changer for what you're doing?
Yeah, I love secrets too, because again, the whole tech world's wrapped up in NDAs, right? You can't use someone's bathroom without an NDA in the tech world. We published our playbook as a book last year. So my co-founder, Jumani, and I literally published a book. It's called Berkshire Africa. It's available in hardbound, paperback, and Kindle on Amazon. Right, self-published, but it's published. Yeah, so all our secret sauce is sitting in the book. We're working on version 2 of the book, or revision 2, because the third part of the book was about the public markets and what we thought would happen. Now that we're public, it's been revised on what did happen and a little bit about what we think will happen next. And we did announce at our annual earnings call and our Q2 earnings call that we are working on an ETF. So our next foray in the capital markets is to wrap Africa Eats and its public portfolio companies in an exchange traded fund so people can buy them all at once. And maybe strangely enough, we're launching that first in Kenya. So we're all live. These 3 companies are public on the stock exchange of Mauritius, not the New York Stock Exchange and the NASDAQ. So in Africa on a mid-sized stock exchange out here. And then we're doing the ETF first in Kenya, because they don't have one yet. They don't have an equity ETF. They just got an index fund, their first one ever. So, but this will be the first Kenyan ETF, and then we'll bring that around to the rest of the continent.
Very, very exciting. Luni, I want to thank you for coming. I think what you're doing is inspirational. It's just, when you start from scarcity and then you see so much abundance, there's definitely so much value that you're creating in Africa, and definitely a masterclass in how you take a proven model and then apply it to a continent that, I feel your energy, like, let's try it, but with so much conviction. It's really contagious. So thank you for telling us your story, and also wishing you the best of luck, because I think what you're doing is very, very important.
All right. Thanks for having me on. Thanks for letting me share.
Of course. And welcome anytime. Hopefully in 5 years, you will tell us, look, we are, or maybe too big for the podcast. Hopefully you'll remember and come back.
All right. Sounds good.
Thank you.
Take care.